Well, as we mentioned, futures under pressure this morning, still reeling from Tuesday's U.S. credit rating cut. Is Fitch's downgrade the break that investors and markets have been waiting for, cooling off a hotter run year to date? Or is the cut cause for serious concern? With us now is BNP Paribas U.S. senior economist Yelena Shulyatyeva, alongside Yahoo Finance's Miles Udlin. Yelena, thanks for being here.
Sure.
Appreciate it. The Fitch rating downgrade is sort of still percolating, it feels like, through everyone's brains as well as through the system. And yes, yesterday it felt like it was somewhat in reaction, the action we were seeing in the market, but it also felt like maybe a little bit of an excuse for markets to take a breather, right? And we were hearing from a lot of pundits that they were sort of confused by the timing of the downgrade at the very least. How are you thinking about it?
Totally. The timing could have been very surprising, coming, more than a decade after the S&P downgrade and 2 months after the debt ceiling debacle was resolved, actually. So things are not looking that bad in the near term, but this is definitely a long-term issue for the United States. So the downgrade itself is not surprising given how unsustainable debt levels are and how it keeps growing at a very rapid pace. And, not even talking about the governance issues. So I think it's a long-term issue for us, and we will be talking about this decades and decades going forward if this unsustainable path continues. This is something that future administrations will need to take care of, and if we don't, we'll just end up paying such high taxes that we will not be able to afford anything else. So I think it's an issue, and it's not surprising that they did that. The timing was a little odd.
Do you think, Yelena, that this brings the kind of fiscal conversation into more focus in the U.S., mostly because if you kind of go back to even 2016 when Trump was elected, certainly the way that both administrations coming out of COVID have viewed the deficit, which is, it's fine, I don't really care. Does this kind of get us back to maybe not the austerity enthusiasm we saw right after the financial crisis, but more of that conversation? Because it does feel like for both parties, the most important presidential candidates, most important leaders have kind of said, you know what, we're just going to spend and kind of figure it out later.
Look, fiscal policy can and should work during the times of crisis. I strongly believe in that. But, when times are good, you should start thinking about how sustainable things are. Think entitlements. Nobody wants to touch that. You have to address that one way or another. And that's a reality. That's not something that we will be able to avoid.
The outcome of all of this yesterday, or at least one of the knock-on effects, was we're seeing bond yields start to move higher, right? There's been some selling in the bond market. Oh, you look like you're doing a big sigh because you don't think that was the reason that we were seeing the action in the bond market, or what do you think?
I think in short term, what else are you going to invest in? Like treasuries is still the safest, asset out there. So what are you going to replace it with? That's why I'm saying this is not a short-term issue. This is more of a longer-term thing that we all have to worry about. By the time we retire, will we be able to afford, the essentials, or not even talking about some discretionary spending, and overall how the economy will do. But it will be a concern of each one of us, I think.
All right, so let's get to the week's main event tomorrow morning. We're going to get the jobs report, and just thinking about the state of the labor market right now in the context of an economy that continues to outperform essentially what most everyone thought we would see into 2023. How are you thinking about Friday's report, both in the context of what it means for the Fed, might do next, which is the kind of primary concern all the time, but just the general arc right now of what we've seen in the economy the last 6 months?
So I would characterize it as gradual cooling. So why gradual? Because things are still very tight in the labor market. You still see jobless claims at the levels that are very low, and there is no hint of any immediate crisis in the labor market. But at the same time, if you look at the JOLTS data that we received earlier this week, you see a gradual slowing in hiring. So it's not that companies are laying off workers. It's the pace at which they hire new workers, and that is slowing. That's at the lowest level since the expansion began. So, and back to pre-pandemic levels. So job openings are falling as well. And but if you look at the ratio of openings to unemployed, it's still at a very high level, and it's showing that demand continues to exceed supply of workers by a very large degree. So, things are cooling, and this is what we are going to see tomorrow, in our view. Despite the rebound that we are projecting, we are at 225, slightly above consensus. But if you plug that number into and do some arithmetics, it's still below the recent trend, the 12, 6, and 3 months average, if you look at overall trend in the labor market. So gradual cooling, this is what I call it.
So then, in thinking about the Fed, you guys are expecting a pause in September. Is September the end for you guys? And I guess, my takeaway from the press conference last week was, of course, the Fed forecast, or the Fed staff has cut their recession forecast. Does that change how you might think about the SEP in September? And just where do you think the Fed goes longer term from here?
I think first of all, in terms of SEP and the meeting in September, we do expect a pause, a skip. And in November, it will probably be too late to raise rates because the economy will slow down. In terms of SEP, we think that the Fed will revise inflation projections, and they will probably revise growth to the upside. So the Fed is very high in terms of inflation projections in their latest SEP, and it looks like things are slowing down much faster. But that's what is happening. So inflation is falling much faster than they were thinking. So, and that will allow them to forego that September rate hike. So I think for the Fed, they will refocus more on the labor market. But for now, we are really watching closely any inflation reading, which we also expect to decelerate.
So yesterday, Bank of America said, we're not expecting a recession anymore. Is a recession still coming?
I think it's too early to call it off, I think, in our projection. I think there are a lot of headwinds that we will see going into the fourth quarter of this year. So you still see a lot of tightening in the lending conditions. We just got the Senior Loan Officer Opinion Survey, which is showing significant tightening in both the commercial and industrial sector and the consumer sector. So that's one thing. It's still present. So I think prior tightening from the Fed is still percolating through the economy. On top of that, you'll get student loans payment resumption in October. That will take some steam out of consumer spending. You have your excess savings, depleted by the end of the year. This is our projection. So there are a lot of things that will combine towards the end of the year to really put a brake on economic growth. Though inflation will be a tailwind.
Well, that's what I was going to ask, because we actually have had some people come on the show recently and say they expect us to see an uptick in inflation towards the end of the year, perhaps a little bit of a resurgence or reacceleration. I mean, if that happens at the same time as the stuff you're talking about, that's not necessarily a good thing.
Right. Well, look, so for now, inflation is cooling. So that is a little bit of a tailwind for the economy, for the consumer. We could see some reacceleration in inflation towards the end of the year, just on the base of the base effects and energy prices. But yeah, that could well be another headwind if it really accelerates. So I think it's still quite a possibility that growth will decelerate quite significantly towards the end of the year, and we may see a mild or moderate, whatever you want to call it, recession still, which would mean there is some pickup in the unemployment rate, unfortunately.
Yeah, well, today we got that jobless rate, at 227,000 for the week, so still pretty low level. All right, Yelena, thank you so much. Yelena Shulyatyeva, BNP Paribas U.S. Senior Economist. Good to see you. Thank you.